Hello, everyone. Thanks for joining us today as we continue our preparedness for the TRID implementation, which is TILA RESPA Integrated Disclosures. As all of us know, we will be implementing that on October 3rd, and we've done several webinars getting ready for that. So today we're going to spend a little time with the history of some of the compliance, the regulations, how we got here, a very short period of time on a recap of some of the webinars we've already provided. And I want to remind everybody that we have a webinar archive that talks about in-depth, granular, what the LE looks like, what the CD looks like, what the concepts look like, several other things. So we will highlight again today things that are new, things that we think have had more clarity to them, and then bring out what we think will still be some of the challenges, and we'll talk about some of the processes. One of the other parts of this is we are getting prepared for additional training that will happen about 10 days before we actually roll out TRID, which will be, I think, September 25th, and we'll talk about that later. My name is Gary Martell. I think most of you know I'm one of the owners, president of Mount West, and I'm joined by our VP of Compliance and Legal, Ann Savage. And Ann, I think we'll let you get started today.
All right, well, let's start with a tiny bit of history. We won't go into a lot of depth. As you may remember, the final rules for TRID were issued in November 2013. There were some changes to the rules in 2014, and originally the effective date was supposed to be August 1st, and that was pushed back to October 3rd. So the TRID rules will apply to applications taken on and after October 3rd. So just to be cognizant of the fact that there will be an overlap period where applications taken before then will be on the GFE and HUD, and they will have to close out that way. So we'll have a period where we're working with both the GFE CD and the LE CD and the GFE and HUD. All right, so what's changing? Of course, the loan estimate is replacing the initial TIL in the GFE. I have the citation there if you want to go look at the regulation. The CD is replacing the final TIL in the HUD-1. There's some changes to the timing of some of the disclosures. In particular, the CD is required at least 3 days before consummation, so that's a change. There's some changes to the tolerance for the fee estimates, and we'll go over that a little later. And there's some new pre-disclosure requirements as well as some servicing requirements, which we'll just touch on. So the applicability of the TRID rules, this will not apply to all transactions. It will apply to most that Mountain West does, but it's important just for your knowledge to know that the rules do not apply to reverse mortgages, home equity lines of credit, chattel dwelling loans, which are usually mobile homes not attached to land, loans by people that make less than 5 mortgage loans annually, and certain no-interest loans for rehab, down payment, or other similar type loan programs. So there are a few more things other than the LE that we're going to have to change up front in the beginning of the transaction, and one is pre-disclosure restrictions. So if you have a client or a potential client prior to having a full application, that they might want a fee estimate, but you don't have enough information to yet issue the LE. So we can do that, and we'll have a form in our system for this, but we have to make sure we're using the right form because there are specific requirements that must be on there. The first one is that there's a disclaimer at the top of the first page. It has to be in at least 12-point type, and it says your actual rate payment costs could be higher. Get an official loan estimate before choosing a loan.
And so let me kind of just talk about some of our scripting that we should have with borrowers. If you're a loan originator, one of the key components here is you cannot require documentation from the borrower prior to providing a LE. But many times you'll meet with a borrower to pre-qualify them for a transaction and they don't have a property yet. And this is really important because if you can get to that borrower before they've identified a property, many times your realtor partner will ask for a pre-approval that they can take to the selling agent or the seller and say that the borrower's been pre-approved. In order to do that, most of us want to look at the documentation that the borrower has. So you can request documentation from the borrower as part of the pre-approval process. Just know that once you have the 6 items, and Ann will touch base on those 6 items again later, but they're pretty much what's been in effect now. As soon as you have those, you have 3 days in order to disclose the LE. And if the borrower says, no, I do not want to give you any documentation prior to receiving my LE, you have to honor that request and not and provide them an LE without that documentation. So we want to be careful. If we can get to a borrower and pre-qualify or pre-approve them and ask for documentation and get that from them, we're able to do so. So don't, there is a misnomer out there that you can't get documentation prior to the LE. You can request it. If they do not want to provide it to you, you cannot require it. There's a difference. Once you start a loan estimate period, so you've taken an application, they have the 6 items, you can still request documentation as part of your application process, but just know you cannot hold up an LE for that documentation. So we'll probably have more dialogue around scripting and how that works later, not today, but in our final trainings leading up to this. But just remember, you cannot require documentation prior to giving them an LE if you have those 6 items.
Right. Another pre-disclosure, or I shouldn't say pre-disclosure, disclosure requirement is the special information booklet. So we currently have these disclosure requirements, but really the documentation itself is changing. So there's 2 different booklets that have to be given within 3 days of application, whether it's a retail transaction or it's one you're brokering out. The first one is replacing the settlement cost booklet. This is for closed-end 1 to 4 family purchase money loans. That document has changed to something called Your Home Loan Toolkit, a step-by-step guide, and that's published by the CFPB, and that has to be given within 3 days of application. Now, when we do our disclosures through eSign and Conform It, this document would be included in that package, so you don't need to worry about it. But if you're doing it in person, you need to make sure that you're giving them this disclosure.
And I do know that Dina from admin has reached out to the branch managers and asked them if they want to get some of these booklets so they can have the printed material in their offices. That's an option. So if you are working at a branch or a branch manager and you have not obtained some and you want some, please contact Dina in admin.
Right. And then the other document is for HELOCs. So that one is called When Your Home is on the Line, What You Should Know About Home Equity Lines of Credit. And that's the same disclosure that we have now, but we're expecting that will be updated shortly as well. Okay.
So I'm going to cover a couple of the differences and what the LE looks like. Now, again, I want to remind all of you that, first of all, you should, if you're an originator, you should have pulled an actual LE and a CD, looked at them, and know these forms, because your consumer, your borrowers, your client's going to require that you be able to explain information to them. So if you've not done so yet, you need to do so now. Also, we have a much more thorough webinar training on the LE and CD. So I'm going to touch some important concepts in here now, but there's a much more in-depth webinar on the LE that's on our archive in our training portal.
Right. So if you go to the Compliance Resource Center, it's at the top of our homepage. That's where you'd find it. You click on that and go down there, and there's a list of training seminars. You click on that, and it'll plug you right into whichever one you want to choose.
So just some real big changes up front. Mostly the same information. It's a new format, right? The information most helpful to consumers is on page 1. We think this is a big win for consumers and us as an originator, as a lender going forward, so we can point the consumer to really the questions that they have, which is how much is it going to cost me and what's my payment. It adds more information such as essential cash to close and total interest paid or percentage, and that's on page 3, and we'll touch base a little bit. The APR has been moved off the front page since most people didn't really understand what that was anyways, and they've moved it back to page 3 of the LE, which again is more appropriate because it's information. It makes sense to help shop, but most people don't really understand, most consumers don't really understand what an APR compared to the interest rate is anyways. And so now they put TIP in there, which is just one more term that ought to keep people fairly confused. That will give information to people if they want to shop side-by-side models. The other part that I think is a big win is we can actually have the consumer sign the LE to show that they've received it. And not only is that good for compliance, but that's also good for us as originators when we're having conversations with somebody during the transaction. They go, no, I never remember seeing that, but you signed the LE on page, you see where you signed it here, this was 3 weeks ago you were given this information. So that's a valuable tool for us as originators as well. So let's kind of just look at a couple pieces of the LE. And again, much more in-depth training is available on the website. This is just the top part. The important part here is you look at it, it shows information about us, whether it's a purchase, a refinance, a type of loan. And then under loan terms, you can see where it says loan amount, interest rate, monthly principal and interest payments. That's big to most clients. They're going to want to see that. And we think that besides that, it says prepayment and balloon, and those are a lot about the loan. If you go still on page 1, down below that, this can have, I think it's up to 5 different compartments, 5 different fields that allow for payment changes. As you can see, we're only showing 2 here in this example, but if there were 5, we'll say like an interest-only period, and then maybe when MI drops off and some other things, you might see 3 or 4 different groups of payment calculations. A lot of times on a fixed rate loan with no MI drop off, it would only be 1. So this is just showing 2. And again, as you can see on this example, we have $82 for mortgage insurance for the first 7 years, and then that drops off starting year 8, and then it just shows what the payment stream would look like without that. But if there were an interest only or an adjustable or other things, you would see some different changes there. So you could have up to 5. If there's more than that, it has to be disclosed elsewhere. Fortunately, we don't have complicated enough products that we have more than that. Also below that, it shows where you're getting your estimated of taxes and insurance, so you can add that into your escrow payment, and it shows the amount and shows if property tax and homeowners insurance is included. Still on page 1, and I think this is probably one of the best parts of the new LE versus the GFE, is we're actually able to show the borrower a summary of what their estimated closing cost is and estimated cash to close. So again, we're just showing you little bits and pieces of the form, and we're going to have a little more discussion on that in a second. So let's talk about fees and fee variances. There's 3 variance classifications, and this is not really so different than what the GFE looks like today. You have 0 variance, which means they can't change at all. That would be like loan origination fee or anything that the borrower, a service that we provide or one of our service agents provides that the borrower can't shop for. And that would be like an appraisal fee, credit report fee, things that we are going to impose on the borrower and they can't go and look for somebody else. Or obviously our commissions and processing and underwriting, that stuff. We know what that is when we take on the file and put out the original disclosure. So there should never be a change on those anyways. Then we have a 10% variance, which is items that the borrower was able to shop. We'll go through that, but one of the things is ones that the borrower was able to shop for, and if they took a service provider that was on our list, then we would be held to a 10% variance. And we'll look at a couple in there. Then also we have no variance, and no variance means like homeowners insurance or something that we really have no control over. The borrower is going to go out to whatever insurance company, and that can change no matter what, because again, that's not a settlement service provider that we're involved with. It may be something the borrower goes out, or any other service the borrower goes out and obtains during the process that has nothing to do with us. Fees changes are only allowed if it's a valid change of circumstance, exactly like it is today. When we start a transaction, we should know what all the fees are, and we're going to estimate for some of the ones that are in the no variance, like homeowners insurance. But the ones that are 0 and 10% tolerance, we should be pretty right on, and probably won't need a change of circumstance unless something unforeseen at the application process pops up, or that's really the only time that you have a valid change of circumstance. And one of the important factors, and this really gets into the weeds a bit, but if you have a change of circumstance and it's a certain amount and it doesn't meet the 10% bucket, then it doesn't reset the baseline, which means that your 10% stays the same. Even if you've had a change of circumstance, you're still held on the next change of circumstance to that first
10% calculation.
The first 10% calculation.
The only time it resets is if you have a change of circumstance that goes over 10%, and then you can reset the tolerance.
and then start all over again.
And start all over again.
Yep. And again, that just, again, it feeds back to your first LE, your loan estimate, which your consumer is requesting from you should be correct to begin with. So we're professionals. We should be able to, we know what our fees are in most cases. So we're going to look at page 2 on the top, and this is where we start to try and put these into buckets of whether they are, whether they can have 0 variance, 10% variance, or no variance. And again, like I explained, anything to do with the loan cost, 0 variance, which means once you put that estimate out there, it can't change. Just like today, though, if you're not locking in the interest rate and credit can change only as long as it's affiliated with the rate until that's locked, and we'll discuss that in a slide or two. Services you cannot shop for, and if you look down under section B, it shows services that you can't shop for, and like I mentioned, usually there are fees that are imposed by us as a lender through one of our service providers, like an appraisal fee. So since the borrower can't shop for it, there's 0 variance. Once you put that fee out, that's what you have to charge. You can always charge less, but you can't charge more. Then we're going to move over to the top of the form. I'll get back to the bottom of it in just a moment, but once we get over the other side, you see it says other costs, and it talks about taxes and other government fees. So you've got a 10% variance, and transfer taxes 0 variance, and that's really important. We are using a service fee provider off of First American to come up with those transfer fees. If you elect to put those in yourself, remember, excuse me, there is 0 variance on those. So once you put them out there, they cannot be more than what you disclose, or otherwise there's a cure. Prepaids, obviously, which has to do with homeowners insurance, taxes, and those type of things, there is no variance, which means that we're not held to whatever those are, except there's mortgage insurance in there, and of course that is considered a loan fee, and it drops back into the 0 variance bucket. Initial escrow payments, no variance, and again, this has to do with taxes and insurance, that type of stuff. And then other, typically other is going to have some items in there that has nothing to do with the loan, and typically, like maybe an HOA fee or something that pops up, or if the borrowers agreed to pay for something that we're not aware of, that may drop into the other bucket. So let's look at the bottom of the page real quick. And on the bottom of the page, we had C, and C, goes A, B, C, which has to do with loan expenses, and C on the bottom here says, well, these are services that you can shop for, and if you choose one that's there, then there is a variance of up to 10%. The important thing with this going forward is people have used this 10% bucket and said, well, if I put in extra fees there, then it grows that initial total of that 10%. And that's what I can apply to. But coming back, if we put a survey fee in there in the first time around, excuse me, and then when we get ready to do our CD and there's no survey fee, you have to eliminate that $65 before you do your 10% test. So that prevents people from putting in additional fees just to pad that category, so it gives them a little more room. So the other thing, again, as you look, we're going to talk about lender credits. There's 2 different types of lender credits out there. Conceptually, if you give a lender credit because of interest rates, so they choose 4 as opposed to 3 3/4, then they're going to have maybe potentially a larger credit, or a credit by going with the higher interest rate. Once they lock in, that credit's pretty much defined. But while they're not locked in, realistically it's an estimate. So that credit can vary based off of when they finally lock in their interest rate, or if they change the rate. But a credit that can't change is if you specify a credit for a specific thing. So if you say, I'm going to pay for the appraisal, so we show a $405 appraisal fee, and then we show a $405 credit for appraisal, and for whatever reason the appraisal comes in lower or there is no appraisal required, you still have to honor the $405 credit, because you can't remove a credit that was tied to an offset of a fee. Did I say that properly?
You said that right.
That's nice. Okay, so let's, so additional information about the loan. And again, this is on page 3, so we now start to talk about if it's a lender, the NMLS license, loan number, and so on and so forth. And again, you should have printed this form, and you should have these. Now, every time you're in a waiting area somewhere and you got a couple minutes, look over this form. So highlight stuff, call us here in our disclosure department, call the legal department, You can even call me if you've got questions on it that maybe has not been addressed in one of our trainings. And the last thing I want to really focus on today is there's a couple key figures that are back, and as an originator, if you want to make sure that you can explain APR, you've had to do it for years and years. You know, there's an interesting thing here, what in the first 5 years, the principal you will have paid if you pay your normal payments, and the total that you will have paid in interest, mortgage insurance, and other costs, and then how much of that is principal. And then at the bottom we have a new figure called TIP, which is total amount of interest that you will pay over the term, the loan term, as a percentage of your loan. So again, as interest rates go up, you're going to see that figure go up dramatically because again, it's the total amount, you know, what percentage of your payment is actually being put to interest as opposed to what percentage is being put to principal over the life of the loan. So that's an interesting figure. And again, it's just one more thing for borrowers to look at and ask you about. So you should be prepared as an originator to answer those questions. The last thing on page 3 that we're going to go through has to do with some other considerations. And this just talks about servicing, refinance, late payments. I think it's interesting that if you look at the one part down and it says refinance, refinancing this loan will depend on your future financial situation, the property value and market conditions. You may not be able to refinance this loan. I think most people knew that, but obviously there was some challenges, so they've had to come back and readdress this in a statement on the LE itself. So Ann, why don't we talk about some timing?
All right, that sounds great. So I think just like the GFE, I think we all know that we have to give the LE not later than the 3rd business day after the creditor receives the application. One thing to remember, just like today, if it's not provided in person and we decide to mail it, it's considered received 3 days later. So when you're counting for different reasons, you just have to remember you might have a mailbox rule to consider for when they've received it. The application has been defined specifically to include 4 or 6 items: the name, income, even if it's verbal. Remember, you can't require them to provide documentation, but if they verbally give you their income, we have the income for purposes of determining if we have an application. Social security number, property address, estimate of the value of the property, and the loan amount sought. So once you have those 6 items, we have the clock starts ticking on our duty to provide the LE.
And remember, in LQB, this is going to be considered a loan, not a lead at this point. So as soon as you have all 6 items, whether it's a refinance or purchase, boom, it becomes a loan and it kicks off the 3-day delivery.
Right.
It's really important to make sure that you get proper contact information for your borrower so that we're able to e-disclose not only for the LE, but as we'll talk about in a minute, to make sure that we can keep the closing process by getting the CD to them as well.
Right. And if for some reason, once you get all this information and you have the application and it falls through, if you can cancel the loan within 3 days and not provide the LE. But you have to go through the cancellation process, but you can keep the information and still work with the borrower going forward.
And we find that a lot in our pipeline management for possibly a refinance where the borrower, for whatever reason, they don't want to proceed. Maybe the property is not going to appraise or whatnot. We see that you can cancel the file out, go through that process. It will become a canceled file, but you can still copy it over into the sandbox and be able to work and give a borrower scenarios until they're ready to proceed, and then that becomes a loan again.
Right. Thank you. Okay, so as we all know, the loan estimate has a good faith requirement, just like the GFE. So the figures must be in good faith and consistent with the best information available. Generally not considered to be in good faith if the charge exceeds the estimate. As is the case now, we can't revise our fees due to technical errors, mistakes, underestimation of charges, or miscalculations. So it's really on the lender. If we make a mistake, we're responsible for that, not the borrower. You may revise certain fees if there's a valid change of circumstance, and the same rules apply as currently for COCs. There was some talk, if you remember from prior presentations, that locks might have a shorter period, but that was overturned. So all COCs are require the LE within 3 days of obtaining that new information. And
I think it's important to restate that if you have, excuse me, a valid change, once you're notified of a change and you have that, you only have a window of 3 days to be able to redisclose. Otherwise, you lose the opportunity to redisclose as a valid change circumstance, and it automatically becomes a cure.
So let's turn to the closing disclosure. We're not going to go over the closing disclosure in as much depth as we did with the LE. We'll probably do that in our next presentation. But we do want to talk about some of the differences from the current HUD 1. So it's mostly the same information that we're already providing the borrower at closing, but it's in a different format, and it has to be provided earlier. Page 1 of the CD mirrors exactly the LE, and the theory behind that is so that the borrower can compare the important loan terms very easily between the two documents. The costs are itemized with columns indicating who is paying it and when it's being paid, whether it's POC on page 2. They've added information to show changes to costs and how cash to close is calculated. That's on page 3. The Fed box disclosures that used to be on the till and the big bolded box on the first page, while it still contains important information, that has been added to page 5. So it's pushed back a little bit further, some of that information. And as with the LE, the borrower can sign the CD to confirm receipt.
So, and just from and our next webinar on the 25th of September, we'll go in much more detail. But just conceptually, when we get ready to put out a CD, we will be having a coordinating with our closing agent through a portal that we have up, that we will send them a copy of the CD for them to look at. We discuss the fees back and forth, and when we're ready, we'll put the CD out to the consumer. So we want to make sure that we're coordinating with our closing portal, and that our group that's going to be providing that out to the closing agent understands that it'll be through the portal that we work with initially until we get it dialed in, and then we will send that CD out to the consumer.
Right, and we're anticipating sending it to the consumer at least 7 days prior to consummation.
So in theory, we would probably start the CD preparation about 10 days prior to that, so that when we go back and forth with our closing agent, we're ready to actually put it out to the borrower in that 7-day period.
All right, so as we touched on, the creditor is responsible to ensure the consumer receives the CD no later than 3 business days prior to consummation. If you remember, consummation is usually in most states before when the borrower signs the contract. In all the states Mountain West does business, that is the rule. The settlement agent is responsible for providing the CD to the seller. So that'll be a separate disclosure in most cases. The CFPB allows it to be a combined or separate, but because of privacy concerns and needing everyone to sign off on sharing of that information, we anticipate it'll almost always be provided as a separate document by the settlement agent. And certain investors, such as Fannie Freddie, are requiring a copy of the seller's CD in the file, so that means most creditors will be requiring that as well.
Yep.
CD also has the mailbox rule, which is why we're going with the 7 days prior to consummation as the target date for delivering the CD to the consumer. Because if they don't e-sign and they don't pick it up in person, we may have to put it in the mail, and that adds another 3 days to the process. So in order to avoid delaying consummation and closing, we want to get that out 7 days before the scheduled closing date. So the business day defined, we've talked about this in prior programs. I'm not going to beat a dead horse, but it's important to remember that how you count the days is different for an LE versus a CD. So there's workflows and such in the LOS that should help us with this, but it's important for you to know why we do things. It'll make more sense. It'll be easier for you to explain it to the consumer. For the LE, the business day is each day that the creditor is basically substantially open for business. So for us, that's Monday through Friday. When you're calculating closing disclosure business days, it's all calendar days except for Sundays and 10 major holidays, legal public holidays. Okay, so Gary's going to talk about revisions and corrections to the CD.
So the creditors must redisclose the CD if changes occur that cause the disclosure to become inaccurate. Now remember, this CD takes the place of a HUD-1. So this is the borrower's closing estimate, and then it's the borrower's final tally of all the fees that they've had to pay and credits that they've received during the transaction. So at the end of the transaction, it must be completely accurate. A couple things out there. There's been rumors about how long, and this is going to delay process, so on and so forth. So again, remember, if we get it started on it, we collaborate with our closing agent early on and then get the initial one ready to send out to the consumer 7 business days before anticipated closing date, usually that should keep us on track. The other thing that's really important is that there can't be changes. And if there are certain changes that have different waiting periods. So we'll discuss the first one here, which is change to the CD that would require a 3-day waiting period. Number one is APR. So if the APR goes up or down 1/8 of 1%. A lot of people say, well, what if it goes down? Well, there's some talk out there. If it goes down and it's not due to APR calculated fees, and there's some real nebulous.
Right. If the APR is changing as a result of a change in the finance charge and it goes down, arguably we wouldn't have to redisclose and have a new 3-day wait. But making that determination is very complex, and most creditors don't want to try to be responsible for that. So if it goes up or down, generally they redisclose. But
again, 1/8 of a percent is a lot. Now this is for regular mortgages, and that's typically all the loans that we do are normally considered regular. Now irregular mortgages, which are more complicated typically, allow for a 1/4% APR. Now again, the definition is quite diluted. So most lenders will stick with the 1/8 of 1%, which we as Mountain West will. So most of the products or all the products that you have out there, if the APR changes by more than 1/8 of 1%, then we're going to have to redisclose a CD and put another 3-day waiting period. So if the loan product or feature changes, right, an adjustable to a fixed or a step rate or neg-am or interest only, those type of things. So I don't anticipate that you're going to have one of those changes 3 days on a CD before closing. Otherwise, you've got more issues because it's going to have to go back to underwriting, and we're going to have to relook at cash to close and rerun it through the automated underwriting system to make sure that the new payment stream works and so on and so forth. And as you know, you can have a fixed rate approved and you turn it into adjustable and it's not approved because it looks at that as another risk factor potentially to the borrower. The other thing is prepayment penalty. Since we don't offer any programs currently today with prepayment penalties, this shouldn't be an issue. But again, if at some point in time we were to, and you were to try and add it on to the CD, it would stop or require a new waiting period. But a little bit more than that. So let's just discuss in general. First of all, we should know before a CD is ordered and sent out to the consumer, we should know what our fees and our service provider fees that we are responsible for are. Otherwise, we should never send a CD out. This is not an estimate anymore. This is the closing disclosure, which says this is what it's going to cost you the day of closing or the day of consummation. Now, that being said, there may be minor things that are done to maybe prorations or tax credit or something that is coming out at the last minute. And if that does happen, then we are able to redisclose on a CD, because again, it didn't change the APR and it's not a change of loan and it's not a prepayment penalty. We can redisclose and we can close the next day. Now, a lot of people say, well, can't we just do that at the closing table? Well, you can, except that the borrower always has the right to view the closing disclosure, the final closing disclosure, 1 day before consummation. So unless the borrower signs something that says, I don't want to review it 1 day before consummation, in most cases we're going to want to see the final CD out at least 1 day before they are signing their documents. And you know, our changes, I think as a company, we should be able to have that dialed in. Again, we're always anticipating that our closing agents, our other settlement service providers that are involved with the transaction, and our real estate folks are educating everybody in this transaction. The key to success here is to make sure that that we don't go in with unexpected closing costs at the end of a transaction. So again, there's only a couple that would require 3 days, and I really don't see that you'll see a lot of those at the end. There's some that would require possibly the borrower to see it 1 day in advance, and there is and those can be changed, but typically by the time they go in to sign their CD or sign their documents, those should have been dialed in. So the next, we can't send a new LE once a CD has already been provided. This is a huge change in our industry. All along now, we've had HUD-1s that are out there. We start with a GFE, right, that we've given them today, and anytime during the process, we start to get a HUD-1 so that we go back and forth and look at that and see if that's accurate, and we send a HUD-1 to underwriting, so on and so forth. Well, an LE is valid till the first CD comes out. Once that's out, then an LE is no longer valid. All changes from then on must be driven through a CD if there's changes that can happen. And again, change of circumstances is highly unlikely once you have a CD out. In fact, there's this thing called the black hole out there that the CFPB has been talking about, and we want to bring this out now because there's still there's a lot of pressure from industry advocates, industry trade associations, and we're involved in several of them that have solicited the CFPB for more clarification on this rule. The rule states today you can have a changed circumstance on an LE provided it's valid, right? Something comes up after the initial LE that was unforeseen, and now you're able to give a valid change circumstance, redisclose to the borrower, move on. Once the CD is out, there's no provision in the regulation that allows for a change of circumstance. Well, that's kind of contradictory to some of the comments that the CFPB has put out. And a big one is if we don't close on time, we'll say there's something happens with the seller or title or whatever, and they can't close the day we anticipated, and the interest rate expires in 3 days, we typically could do a change of circumstance for an extension. If it's something that's valid and so on and so forth. Well, right now in the provision, that's not, from everything that we're hearing from all the legal beagles out there, is this is a black hole and there's no provision to do a change of circumstance. And if that's not vetted out a little better by the CFPB, it's going to create a cause for longer lock periods and some other things that will be probably not to the borrower's best interest. Okay, so if the amounts paid at closing exceed the amount of disclosure on the LE beyond the applicable tolerance, then we get into what is cures, which means we have about 30 days to refund money back after consummation. I thought it was 30, but maybe it's 60 days to refund after consummation. And we must deliver a corrected CD that reflects the refund no later than 60 days. So,
but our policy is 30.
Gotcha. Good. So realistically, we're going to look over the CD immediately after closing and make sure that it reflects the appropriate amount. And if some change was made, then we have a very small window. And in all cases, we're not able to go back to the borrower for more money. The only thing we can do, it's a one-way street with finances. The only thing we can do is refund additional cures that should have been done at closing or consummation back to the borrower. And remember, this has a lot to do with those tolerances, right? So if it was a zero tolerance and somehow at closing we charged more, then we just have to give it back to the borrower than what was disclosed to them. And the same thing with the 10% bucket. If, again, we exceeded that 10% in amount, in aggregate about the fees, then we'd have to return that back to the consumer within that window.
All right, so one other TRID change that's not related to the LE and CD is the servicing disclosures. There's been some changes on that, and it's good to know this for our customers' sake. One is the new escrow account cancellation notice. So if they are voluntarily or canceling their escrow account, there's 3 business days before the account closed, we have to send out a notice. We have to say when and why the account's closed. And we have to notify the consumer that they must directly pay for all property costs. I mean, I think the whole point of this is because people without escrow accounts sometimes don't understand that they are responsible for the insurance and taxes. I'm not sure how they don't understand that, but the CFPB's testing has indicated they don't. So if a escrow account is canceled, they want to be sure that the borrower knows that they're going to have to pay those costs.
So by canceling my escrow account, doesn't cancel my tax requirements?
Nope.
Good to know.
There's also a cost to you table that would be included in this notice, and there's a statement about what to do in the future if you want to reinstate or how to pay your bills. And then if they receive a partial payment, so there's a document called a transfer notice. So when you transfer servicing, we're adding to that a partial payment policy where we have to describe what we will do in the instance of a partial payment. And we also have to tell the borrower that if the loan is sold, the new owner's policy may be different so that they understand what will happen if they make a partial payment. So we have various resources available for your review and the Compliance Resource Center at the top of our homepage. You can click on that and there's a ton of information in there. You can also go to the CFPB website for more information. Our next training with Gary and I will be Wednesday, September 23rd, and we're going to go over specific implementation issues and other things of interest, so it'll be a little more nuts and bolts. Additional issue-specific training will be announced. I think most of that will be conducted by our trainers or be videos, and we have lots of plans on making sure that we're able to make this as easy a transition as we can for our staff. And I just want to thank you so much for attending today's presentation. If you have any questions, you can reach out to me or you can contact Gary.
Thank you very much. Have a great day.